case here, what we want to do is not at their fair market value. We're always looking at cost or cost minus the accumulated depreciation or book value. So again, the one that we're not going to be reporting our assets is always fair market value, and that's going to be A. Now, let's talk about disposing of plant assets. Well, you know what? Sometimes an asset's going to wear out, or you know what? We just don't need it anymore, or it becomes obsolete. So we've got a couple things that we can take a look at. Number one, we can get rid of the asset, we can sell it, or exchange it for another asset. We can definitely do any one of those three, and that's fine. So let's talk about a couple of these things. Now, there's 4 steps, whether you're disposing it, getting rid of it, exchanging it, there's 4 steps you need to do. Number one, you got to bring your depreciation expense up to date, okay, as of the date of the sale. The other thing is you're going to remove the old disposed asset. You're going to get that off the books and any associated accumulated depreciation. So you want to remove the book value of the asset, meaning the cost minus accumulated depreciation. Then the other thing is you want to record the value of the cash. Lastly, you want to determine any gain or loss. This is where you compare the cash received to the book value of the asset. If cash is higher than the book value, normally that's going to be a gain on sale. If cash received is less than the book value, normally that would be a loss. So let's see how this works. Now, in this case, Smart Touch is going to get rid of an asset. So it costed $10,000, and there's accumulated depreciation of $10,000 on this asset. So normally what we're going to do is if we discard it and get rid of it, we'll debit the accumulated depreciation, this time for the amount of depreciation, which is $10,000, and we'll credit equipment, and you know what? That asset is no longer on the books. It's gone, so we don't have to worry about that. Okay, so you can see that here. The equipment account is going to be credited for $10,000, which is going to lower the value. Accumulated depreciation is going to get debited for $10,000, which also lowers the value of accumulated depreciation. Now, in this case here, if let's say here we're actually going to sell the asset. Now, in this case here, we've got a cost of $10,000, but it's not fully depreciated. Okay, and we've determined that the accumulated depreciation is $8,000, and the annual depreciation is $1,000. What we have to do here is bring the asset up to date for depreciation. So on July 1, we've got to figure out half a year's worth of depreciation. So in this case, half of $1,000 is going to be $500. So I'm going to make a debit to depreciation expense for $500 and a credit to accumulated depreciation of $500 also, again, to record the depreciation expense. Now, in this case here, there's going to be a $1,500 loss on this asset because, number one, we're not receiving any cash on this asset, and we're disposing of the asset. And in this case here, my book value of the asset is going to be a cost of $10,000. And then I'm going to have less accumulated depreciation of $8,500. Again, we've got $8,000 of accumulated depreciation plus $800 in depreciation expense for the 6-month period. So we're going to have accumulated depreciation of $8,500. So my book value of the asset is going to be $1,500. So if I take the market value of the assets received, which is 0, take out the book value of the asset getting rid of, and the gain or loss in this case is going to be a loss of $1,500. So in this case, I got a debit to accumulated depreciation of $8,500, a loss on disposal of $1,500, and a credit to equipment of $10,000. Now let's take a look at selling the plant asset. Again, we've got to get our accumulated depreciation up to date here. So again, we'll make that debit to depreciation expense for equipment and accumulated depreciation on the equipment of $500 to get for the half year of depreciation expense. Now, in this case, we're going to sell the equipment for $1,500. So again, I've got a book value on the equipment of $1,500, as you can see. And since my cash that I'm getting equals the amount of the book value, my gain or loss on this asset is going to be 0. So in this case, I'm going to have a debit to cash of $1,500, a credit to accumulated depreciation of a debit of accumulated depreciation on equipment of $8,500, and my equipment balance is going to get credited for $10,000. So this is where I'm recording the sale of cash for the asset. And so there's no gain or loss on that transaction. Now, in this case here, we sell the equipment for $4,000. So again, the cash that I receive is $4,000. The book value of my asset's $1,500. Since my cash is higher than my book value of the asset, I'm going to have a gain on this transaction. So again, I'm going to receive cash. We'll debit cash of $4,000. We'll debit accumulated depreciation on equipment of $8,500. We'll credit equipment of $10,000, and then the difference is going to be credited to a gain on disposal of the asset. So that's going to be a gain. Then the last one that's out here. Suppose I only receive $500 in cash on the asset, selling the asset. And the book value of that asset's $1,500. Well, in this case, I'm going to have a loss of $1,000 on that transaction. Okay, so I'm going to have a loss on this one. So that entry is going to look like this. I'm going to have a debit to cash of $500, a debit to accumulated depreciation on the equipment of $8,500, debit to loss on disposal of $1,000, and a credit to the equipment balance of $10,000. So again, you can see here as a summary, really looking at the assets sold on this one. If it's at book value, there's no gain or loss. If if the cash that I received is above the book value, we'll have a gain. And if it's below, cash received is below the book value, we will have a loss on the sale of that asset. Okay. And again, we've got the journal entries. This kind of summarizes all the journal entries that we have done in this one. So number 16, when a plant asset is disposed of, the business must A, immediately replace it, B, ensure that the plant asset is obsolete or worn out, C, comply with the conservatism principle and record losses but not gains, or D, bring depreciation up to date. The correct answer on this one is D. We're going to bring depreciation up to date because we need that updated depreciation expense amount in order to accurately reflect accumulated depreciation, and that will get the book value up to its correct value as of the date of disposal. 17. An asset was purchased for $37,000 on January 1, 2019. The asset's estimated useful life was 5 years, and its residual value was $9,000. Straight line method of depreciation was used. Calculate the gain or loss if the asset is sold for $19,000 on December 31st, the last day of the accounting period. So we've got $37,000 on the asset. Residual value was $9,000, and estimated useful life was 5 years. We've got to figure out accumulated depreciation for that first year. So we're going to be using straight line on this one. So what's going to happen here is my cost of my asset less my first year of depreciation or my only year of depreciation, which in this case is $37,000 minus $9,000 divided by 5 years, or $5,600 in total. So my book value of the asset is going to be $31,400. Now the cash that I'm getting is $19,000. The book value of the asset, cash is a lot less than the book value of the asset. So again, I'm going to take $19,000 minus my book value of $31,400, and I'm going to come up with a loss on this one. This is going to be a $12,400 loss on this one. This one's B. Now, number 18. The gain, let's see, the gain or loss on sale of a plant asset is determined by comparing the market value of the asset received with is it A, book value? Is it residual value? Is it original cost? Or is it D, salvage value? This one here is going to be A all the way. This one's going to be book value of the asset. You always compare the the market value of the assets received with the book value of the assets sold. Now, equipment was purchased for $24,000 on January 1. The equipment's estimated life was 5 years and residual value of $4,000. Straight line method of depreciation was used. Prepare the entry to record the sale of equipment for $25,000 on January 3, 2019, so a year later. So, for the first thing I want to do, let's take a look at the entries, because that's what we're preparing. Now, the entry on this, on the sale of the asset, clearly I'm going to be receiving cash of $25,000, so I'm going to debit cash. But I got to figure out what's my book value of this asset. Now, it says here that the item was purchased for $24,000. My residual value is $4,000, so my depreciable cost is $20,000. We'll divide that by the useful life of 5 years. So we're getting a annual depreciation of $4,000 a year. Now, if that's the case, we've got $4,000 a year. So I'm going to take $24,000 minus, so I'm going to be debiting my accumulated depreciation of equipment of $4,000. So my total debits right now are $29,000. I'm going to credit my equipment of $24,000. And so the difference out there is going to be a gain on disposal of $5,000. So it's going to be a gain on sale on this one.